Welcome to part 2 of the latest podcast from the Gold Chronicles with Jim Rickards and Alex Stanczyk, presented by Physical Gold Fund.
Mm-hmm. You know what this reminds me of is there was a quote that I heard, and it went along the lines of financial services today consists of the dark art of shuffling and reshuffling the same paper assets over and over again in order to generate larger and larger returns. And just on a scale perspective, just to give people an idea of how big this has gotten, the derivatives market, and I'm sure you know, how big is this in dollar terms, and how big is it compared to everything else?
Well, it's getting close to a funny number, which is called $1 quadrillion notional value. It's a little bit lower than that. It's around a little over $700 trillion, but was converging in on $1 quadrillion. Quadrillion dollars, by the way, is 1,000 trillion. So take a second to get your mind around that. But that is 10 times larger than global GDP, approximately. So global GDP, the entire value of all the goods and services in the world, is approximately $70 trillion, and the gross notional value of derivatives is approximately $700 trillion. So derivatives are 10 times larger than global GDP. So if you think of global GDP as the real economy, that's like real stuff that, you know, I buy and you buy, or we make and sell, or services we provide, etc. So that's real. And the derivatives are 10 times that. So go back to what I said earlier. When you throw 10 times leverage on something, it only takes a 10% drawdown to wipe you out. In other words, a 10% drawdown on the gross notional value of derivatives would wipe out the entire global economy. Those losses would be larger than the total output of the world. That's a pretty daunting thought. But then take the second point I made, which is that it's nonlinear, meaning when you scale up the system, the risk grows exponentially. This is like an extinction level event, you know, in archaeology and geology and cosmology and biology, all those sciences that converge in different ways. They have what they call an extinction level event. That's like, you know, when a comet or an asteroid hits the Earth, or you know, it just causes massive tsunamis and volcanic eruptions and black clouds and freezing temperatures and ice ages, and, you know, some very high percentage of all the life on Earth dies. And then there are a few survivors, remnants, and then little by little, over millions of years, we claw our way back to some kind of life. This is what happened to the dinosaurs. It's happened more than once throughout history. We could be looking at an extinction level event in capital markets. Right.
And so the thing that is really concerning to me, and I'm sure others have thought of this too, is that the people who are driving these airplanes, so to speak, like all of these derivative books are managed by human beings. And the question that comes to my mind is, as you well know, human beings are not infallible. Do these people actually know what they're doing? I mean, you had sort of a front row seat to a situation where, you know, the smartest guys in the room were running big money, and they were considered to be, they could do no wrong. So, like, what is your view on that? And are these guys, do they know what they're doing? I mean, what is the chance? What is the chance that they don't know what they're doing, and that could really lead to some bad results?
Well, it's an interesting mix, and you're right. I was chief counsel of long-term capital management. My colleagues were, we had 16 PhDs, and they were PhDs in finance from you know, Harvard, MIT, University of Chicago, Stanford, Yale, what I call the usual suspects, you know, Columbia and some others. So they were basically the biggest brains in finance. Two of them won the Nobel Prize. So this was we actually had complaints from deans of some graduate schools of finance that we were depriving academia of the next generation of scholars because we were hiring so many top flight PhDs to come work for us. So no shortage of brain power, but absolutely did not understand risk, did not understand any of the things we've been discussing on this call. I wasn't particularly focused on at the time I was there. I was the lawyer, so I was, making sure the contracts got done, and making sure compliance was good, and negotiating deals. I knew what was going on. I mean, I saw all of the contract flow, but I was seeing it from the lawyer's perspective, not the financial risk management perspective. And of course, it all blew up. And we brought the thing in for a soft landing in the sense that we got the Wall Street rescue money. Wall Street didn't rescue us; they rescued themselves. Going back to what I said earlier, they were the count. We had $1.3 trillion of swaps on the books. This is one hedge fund in Greenwich, Connecticut. I mean, this is not like J.P. Morgan Chase, but even our hedge fund, we had $1.3 trillion of swaps. And if we had failed, I like to say, if we had filed for bankruptcy, I would have just slept in the next day. I would have caught up on my sleep after that whole bailout drama. But Wall Street would have been left with all the losses. So they put in capital to keep us going so that they could collect their bets. So they bailed themselves out is what happened. But so that group absolutely did not know what they were doing. Unfortunately, things aren't much better. I look around. I look at the central banks, the FOMC, monetary research staff at, say, the Board of Governors in Washington or the Federal Reserve Bank of New York, other central bankers around the world. What I discover is that these people got the same PhDs from the same schools as my former colleagues. In fact, they were associates. I believe the PhD advisor on at least a couple of the partners at Long-Term Capital was Stanley Fisher, who today is the vice chairman of the Federal Reserve Board. So it's a club. They all know each other. They taught each other. They all believe the same thing. It seems impervious to new learning. They know what they know. So the short answer to the question, Alex, is no, these people do not know what they're doing. Having said that, and by the way, just as a quick aside, there's no better example than around this time last year, Jamie Dimon has an annual letter to the shareholders of J.P. Morgan Chase. So, around April or whatever, they come out with their annual report, and there's always a letter from the CEO. And he was discussing events from the year before, from 2015, when they were in the aftermath of that London whale fiasco. Remember when they lost billions of dollars because of that derivatives trader? Yeah. And based on what had happened, Dimon was saying, this was I forget the exact number, but this is like a 15 standard deviation event. This is something that should only happen once every 3 billion years. It was so rare, et cetera, et cetera. And I read that, and I didn't know whether to laugh or cry. It was certainly an embarrassment to Jamie Dimon, but all of that jargon about the 3 billion years and the standard, that all comes from a understanding of risk management based on what's called a normal distribution of risk. Mm-hmm. Sorry, but risk is not normally distributed. If you look at the time series of movements in any capital market, it could be stocks, bonds, commodities, certainly gold, they don't, the degree distribution is not normally distributed. It's distributed in accordance with what's called a power law or a power curve. And it's not a dry academic argument about the shapes of two different curves. Those curves are just graphical representations of two completely different systems that function in totally different ways with different shocks and different outcomes to be expected. So there's an example from a scary one from the head of the biggest, most powerful bank in the world, practically, that shows that they really don't understand risk. So that's done. Having said that, there are some people who do, who are going along with this because they personally enrich themselves. In other words, if your understanding of a system is, if you can pull the wool over someone's eyes, of course this is anywhere from highly immoral and unethical at best to just outright illegal, depending on who's doing it and how. But I do believe there are people in capital markets who understand, even if they don't understand exactly how risk works, they understand that the standard models understate the risk, which means you can go around and sell garbage to your customers and they won't understand it. They'll sign up for, it's kind of like they're signing up for fire insurance and you're sitting there pouring gasoline in the basement getting ready to light a match. And then the insurance is no good when the fire burns the house down. So that's kind of how they operate. And then there are some people who do get it, but they're they're like me. I mean, they're writing books, they're doing commentary, they're yelling, practically yelling that the system is ready to implode. But if you're not actually running the Federal Reserve, then it's hard to. You try to have impact, but it's a challenge. So I think most of the policymakers have no idea what they're doing. Mm-hmm. Some do, but they're kind of in it for the money because they can enrich themselves. Others do, but they're kind of not in a position to change policy except through influence of writing and speaking. Eventually, things will get straight. The question is, how much more damage will we have in the meantime?
Yeah. I can tell you from personal experience that I concur with that in that a large number of former Wall Street, some of them still on Wall Street, either traders, people who've run large companies in financial services. I've seen them go to gold and buy gold for the very reasons you're talking about, and the financial media and a lot of people in sort of positions of credibility in financial services, they may not talk a good game about gold, probably because they don't make any money selling it. But at the same time, I have seen them go to it for the very reasons we're discussing. So if we can, let's shift our attention to the national debt. And sort of where that's at, how it gets serviced, and what are the outcomes there, and what are the solutions. National debt sitting right about 20 trillion. The debt ceilings have been a big discussion lately. From some analysts I've read, there's as much as maybe 10 trillion, depending upon how you work the numbers, of additional deficit that's probably going to end up happening because of spending that's basically already been approved and on the books. So you recently said real economic growth is simply a matter of how many people are working and the productivity of those workers. What is the productivity of those workers? So demographic trends are what they are. There's not much we can do to change those forces. In much of the developed world, we've got an aging workforce that is not being replaced with the same number of younger workers. And combined with the fact that productivity has been stagnant, not really growing sufficiently to service the increasing debt burden, we've got a math problem here that does not really seem to have a plausible solution. So we've discussed over time, as you know, that if certain structural reforms could help with this, but there's no political will to do so. And therefore, one more reason for people to get their financial house in order, so to speak. So the way I look at it is time is sort of growing short, maybe too short, for systemic changes to be made. So why do people need to be paying attention to this, and what should people be studying to better prepare?
Well, one of the points you raised, Alex, and I think it's a good one, is that this is a math problem, and the importance of that is, we are so spun up today in, ideology, left versus right, elites versus everyday people, Republicans versus Democrats, progressives versus, nationalists. Take your pick, and everyone's yelling and screaming at each other, and everybody's spun up, and nobody's getting along. But the thing about math is it's math. Math has no ideology. It's just numbers, right? And so you can actually look at this debt deficit problem very clinically, and it doesn't matter if you're a Republican or a Democrat. These numbers are going to come, eat you alive if you don't do something about it. So let's just look at a couple relationships. Throwing out a debt number, $20 trillion of national debt, that's important, but debt in isolation doesn't tell you very much. You have to compare it to your ability to pay, meaning that I look at the debt to GDP ratio. So just a very simple example, let's say you make $30,000 a year and you have $100,000 on your credit card. You're probably going to go bankrupt. I mean, you can't service $100,000 of debt at the exorbitant credit card interest rates with a $30,000 income. But let's say you make $5 million a year and you have $100,000 on your credit card. Well, no problem. You can probably just write a check and pay the whole thing off. The point is, in my example, you cannot look at the $100,000 of credit card debt and answer the question whether that's a bad thing or an okay thing without understanding how much income the person has to service it. The $30,000 a year person is probably going broke. The $5 million a year person is probably just fine. So when you say $20 trillion of debt, big scary number, but I immediately look at it in terms of the GDP. Now that ends up being a scary number because I'll go all the way back to Ronald Reagan. When Ronald Reagan was sworn in 1981, sworn in as president, our debt to GDP ratio was 35%. The numbers are a lot smaller. I can't recite the numbers off the top of my head, but it doesn't matter. What matters is that ratio I just described, 35%. Now, Reagan was actually a big spender, contrary to his conservative credentials. He took the debt to GDP ratio up to 55%, which is a 60% increase. You know, you throw 20 percentage points on top of 35% to start, get up to 55%. That's a 60% increase in the debt to GDP ratio in the 8 years of Reagan. Now, having said that, we got something for the money, which is we won the Cold War. I mean, Reagan spent it on the 600-ship Navy, strategic defense initiatives, so-called Star Wars. He at least spent the money on a lot of good things, and the Soviet Union collapsed. So we won the Cold War. I would say, yeah, he spent a lot of money, but we fought a war, won it, and got something for the money. Now, in the years of Bush 41, George H.W. Bush, and Bill Clinton, the debt to GDP ratio did not go up a lot. It went up a little bit, 61%, kind of came back down again. Clinton actually banged out a couple surpluses, believe it or not, at the end of his administration, but it remained pretty constant in that 60% level. Now, the 60% is a big deal because that's considered the outer limit of the danger zone. If you look at Europe and the Maastricht Treaty and what the members of the European Monetary Union, the so-called Eurozone, commit to, they say they're going to keep their debt to GDP ratios below 60%. And that's certainly what Angela Merkel would. They haven't all done it, by the way. I mean, Greece is off the charts. Greece is, I think, about 120%. But nevertheless, they're held to that 60% standard, and that's how Angela Merkel measures it. Now, Kenneth Rogoff of Harvard and Carmen Reinhart. Carmen was at University of Maryland. She might be at Columbia now, I'm not sure. But be that as it may, two of the leading monetary scholars and economic historians have looked at this closely, done a ton of research, and they think the danger zone is 90%, meaning 90% debt to GDP is the place where more debt doesn't help you. More debt doesn't give you any bang for the buck. It actually retards growth. It slows growth, makes it more difficult to pay off the debt. You start to look more like the person with the $100,000 line of credit or credit card debt and making $30,000 a year. Well, guess where we are today? We're at 105%. And it was by any definition, by Angela Merkel's definition or the Rogoff and Reinhardt definition, we are way, way in the danger zone. Meaning simply that Trump does not have the degrees of freedom that Ronald Reagan had. Trump wants to be a big spender. He wants to rebuild the Navy. He wants to rebuild the military. He wants to do infrastructure and bridges and tunnels and airports and new roads. Well, we all love all that stuff, don't we? But he doesn't have the fiscal space, as they call it, or the running room that Ronald Reagan had, not even close. In fact, he's highly constrained, and Congress is going to insist that as I say, tax cuts be revenue neutral and all the spending, where you're going to get the stimulus that everyone keeps talking about. Now, a couple other things. How do we get out of this? And by the way, Alex, the $20 trillion is just the tip of the iceberg. That's treasury debt. Those are bills, notes, and bonds where we owe you the money and you get some contractual right. That doesn't count contingent liabilities. That does not count. That does not include Medicare, Medicaid, Social Security, veterans loans, federal home farm loans, student loans. All the food stamps, all the conditional and contingent liabilities that the U.S. government has piled on. If you do that, multiply it by 10. We don't have a 105% debt to GDP ratio. We have 1,000% debt to GDP ratio. There's $100 trillion of this contingent liabilities. And I've heard mainstream economists say, oh, well, you don't have to count that because, we could always change the law. Really? You think you're going to get rid of Social Security? I mean, that's just, I know technically you can change the law, but that's just wishful thinking. And it's absolutely not happening in the short run because Trump says he's not touching entitlements. So how do you get out of this? Well, there kind of notionally, there are four ways out. One is growth. You could actually grow your way out of it. What if you held the debt kind of constant or didn't go up very much and you grew the economy faster than the debt was growing? Well, that would lower the debt to GDP ratio. By the way, that's exactly what the United States did from the end of World War II until around the time of Ronald Reagan, as we described. But that gets back to what you say, which is, okay, what is the source of growth? Well, the source of growth is simply the expansion in the labor force times productivity. How many people are working? How productive are they? As there's that old country song, I think Patsy Cline, is that all there is? Well, that's all there is, the working force times productivity. Well, the problem is if your working force is growing about 1.5% a year, and your productivity is about 1% a year, a little bit more, you multiply one by the other, you get a number that's less than 2%. But how much is the deficit going up? Well, the deficit's going up right now. Today, we're in a sweet spot. It's around 3.5% of GDP. But the projections, which just came out from the CBOE, show that we're past the sweet spot, and that number's going to start to go up to 4% and ultimately 5 and 6%. So when your economy is growing, let's be generous and say 2%, and your debt's growing 3-4%, your debt to GDP ratio isn't going down, it's going up. It'll go up from 105 to 106 to 110. You're on the path to bankruptcy, you're on the path to Greece. So growth is a good way out, but it doesn't seem to be happening. Well, it's not happening. Now, what can you do to increase the labor force? Well, one of the big ways to do it is immigration. By the way, people are not having enough kids. I'm going to leave that debate to others, but the fact is demographically, indigenous population is not growing. We've been relying on immigration. Well, what's Trump doing about immigration? Well, he's building a wall through Mexico. Now, again, I don't want to jump into these policy debates. You can be pro-wall, anti-wall, knock yourself out. I'm just saying that this approach to immigration is not going to help the U.S. expand the workforce. And then beyond that, say, well, let's get people off the couch. Let them stop eating Doritos and watching Final Four basketball and get back in the workforce. Well, really, check out the opioid epidemic. I mean, this is devastating, and there's more to it than that. But there are just a lot of reasons to think that we're not going to be able to grow the workforce more than about 1% if we're lucky. And productivity is declining. Economists are not sure why. That's an interesting debate for another day, but those are just the facts. So it doesn't look like we're going to grow our way out of this. The other thing you can do is just default on the debt, say, hey, I'm not paying you. That's not going to happen. Because why should it? We can print the money, right? Why on earth would you default on debt denominated in a currency that you can print? Well, you wouldn't do it. So that's not going to happen. So what's left? Well, the only thing that's left is inflation. And that's what they're trying to get. The irony is that we have a central bank that's been trying for 8 years to get inflation, and they can't do it. That's a pretty sad thing when central bank wants inflation and can't get it. So inflation is the traditional way out, but even that we're not getting the inflation. We look like Japan. I mean, we are Japan. I said that in my first book, Currency Wars. I actually said it before that in 2009, 2010. I said, we are Japan. And the irony was that Ben Bernanke ran around in the 90s and the early 2000s, both as a private economist and as a member of the Federal Reserve Board and later chairman, yelling at Japan saying, you're messing this up. You don't understand how to use monetary policy, and just really bashing the Japanese. And yet he went out and made every single mistake that the Japanese made. And we are Japan, and we'll stay that way for as far as the eye can see. So it's a train wreck, and now it's a slow motion train wreck. It sneaks up on people. It's one of the reasons I own gold, and because it's kind of immune to if we have inflation, your gold will do just fine. If we have a catastrophic collapse again, your gold will do just fine. So maybe that's a good place to wrap up. We'll drill down on gold the next time, but gold is your insurance. It's a pretty gloomy call, Alex. Always a pleasure to talk to you and John, but we've gone through a lot of systemic risk. We've gone through a lot of market risk. We've talked about leverage and derivatives and complexity theory and the debt to GDP ratio, and all these things appear to be pointing in very bad directions, and they are. That's not being a pessimist. That's just being realistic and trying to do some good analysis. But the solution to all of them, at least for the individual, is to get some insurance through gold. I recommend a 10% allocation to physical. If you don't have that much, you start your allocation today and try to get there. Don't use paper gold, either gold in storage, which is what, of course, Physical Gold Fund offers, or just for smaller accounts, go get some coins and bars and put them in a safe place.
Mm-hmm. Very good. Okay, so just want to thank you, Jim. It's been a great discussion today. Really appreciate it, as always. Very insightful, and look forward to doing it again next time.
Indeed. Thank you, Jim Rickards, and thank you, Alex. It's always a pleasure and an education sharing this time with the both of you. And most of all, thank you to our listeners for spending time with us today. Let me encourage you to follow Jim and Alex on Twitter. Jim's handle is @JamesG.Rickards. Alex's handle is @AlexStanczyk. If you've enjoyed this podcast, please recommend it to your friends. If you're watching on YouTube, please click like and subscribe. And if you're listening on iTunes, please give us a rating and a review. You have been listening to The Gold Chronicles with Jim Rickards and Alex Stanczyk, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.